This video is an introduction to the commodity markets. If you're new to trading the financial markets or trading commodities, this is a good place to start. This video is aimed at you. In the video, we're going to talk about the commodity markets in general, and then we're going to look at specifically which commodities you can trade with trading 212. And then we're going to talk a little bit about the futures market, about what futures contracts are, how the futures markets came into being and what purpose they serve. So do keep watching to the end of the video so that you get to hear about all these different pieces of information. Hello, I'm Peter Martin with Trading 212, and we add educational videos about trading the financial markets to YouTube on a regular basis. If you haven't already, make sure you subscribe to our YouTube channel by clicking on the red subscribe button, because that's just the easiest way to learn when we've added new content. Well, there are a dizzying amount of commodities that are available to trade, so let's start by looking at this. If you go to the main commodity futures exchange in the US, for example, this is a list of just some of the contracts that can be traded there. And you can see that there are many different commodities there, from agricultural products such as corn or soybeans or live cattle, for example, to metals such as gold, silver and copper, to energy products like gasoline or natural gas. And then for many of these, there may actually be multiple types of different contracts for each commodity. For example, there are multiple types of wheat and crude oil and all sorts of differently spec versions of coal and electricity. So it can be more than a little bewildering if you're coming to this new to the markets, which is why Trading 212's simple, compact commodity trading service makes things easier to digest. They've streamlined down all these markets just to the more popular commodities. So let's take a look now in Trading 212's app and see which commodities are available to trade there. So here we are in Trading 212's web app, and what I'm going to do is just open this side panel here to take a look at my watch lists. And you can see I've created 3 watch lists: metals, energy and agricultural. So let's have a look at what's in there. So in metals, we've got copper, platinum, palladium, silver and gold. In the energy watch list, we have oil, gas and oil Brent. And then in agricultural, we have got cocoa, cotton, sugar and coffee. So these are the commodities that we just saw in the web app, and these are the commodities that you can trade with Trading 212. So let's run through the list. In the agricultural bracket, we have cocoa, coffee, cotton and sugar. And of these 4, cocoa, coffee and sugar are sometimes referred to as softs in the commodity market. And then in the energy bracket, we have US crude oil, Brent crude oil, and natural gas. That's what we saw as gas in the app. And so we have 2 different types of crude oil then. And we'll look at that in more detail when we focus on oil in another episode of this series. And then in the metals bracket, we have gold, silver, copper, platinum and palladium. Although some of these commodities might still seem a little esoteric, it is actually with commodities that antecedents of today's modern futures exchanges came into being. So let's take a look at this now and what futures are, why they exist, why futures exchanges exist, because it is instructive about the commodity market as a whole and it's useful to know as a trader. Commodity prices, as with all financial markets, are subject to fluctuations. Perhaps that's an obvious point to make. The nature of the beast, though, with commodities is that these changes in price can, at times, be dramatic. If we think of agricultural products, for example, the production of these goods is not uniform throughout the year. Crops, for example, grow in a certain season, are usually harvested at one time of year, and it can often be unpredictable up to a certain point where the crops will turn out to be good or bad. The caprices of the weather obviously have an effect. You may have other unpredictable factors like pestilence, and you might have one year a bumper crop, another year a very bad crop. And so you get gluts, or sometimes you get shortages, and this can sometimes serve to send prices soaring or crashing. And obviously those kind of fluctuations are a problem, a headache, if you are a commodity producer. Let's consider a corn farmer here. So this is our commodity producer. He plants his corn and he harvests his corn and he sells his corn. As we said, the price though fluctuates. As time passes, it can go up or it can go down. And the farmer's problem is that he doesn't know if it's going to be a good price when he's ready to sell or a bad price. If the price is high when he's ready to sell, that's great. But if the price is low, then he's in trouble. So he has an inherent exposure to his corn that he wants to mitigate or offset in some way. So in essence, what our farmer wants to do is to offset his risk. He wants to pass that risk on to someone else. This makes him what is known as a hedger. The way he can offset his risk is by hedging his exposure to his corn, by finding someone who agrees to buy his corn even though he hasn't got the corn ready to deliver yet. The person who agrees to buy the corn is a speculator. They are speculating that the corn that they are agreeing to buy will be worth more than the price they agree on now when the farmer is ready to deliver. They are agreeing what is known as a forwards contract. They are agreeing a price now for delivery of the product later. Let's say that it's February now, and the farmer is getting ready to plant his crop, which will be harvested in August and ready for delivery in September. Come September, the market price really could be anywhere. No one really knows. But the farmer, let's say, has seen in recent years it might get as high as $500 a bushel, and he's worried that it might drop as low as, let's say, $200 a bushel. And then let's say that the speculator is willing to buy it now, or to agree a price now, of $350 a barrel for delivery in September. So this is the price they agree. And that's great for our farmer because he knows what price he'll get in September. If corn goes up or if corn goes down, it doesn't matter to him because he sold it for that price, $350 a bushel. The speculator has taken on the market risk. If corn goes up, he can sell his corn for more than he bought it. The farmer is providing it at this price of $350 a bushel. If the market price is higher than that in September, he's in the money. Any lower, and he's taking a loss. Now, there's still a couple of problems with this relationship, however. One is that it may be difficult for the farmer to find such a buyer. Secondly, if the price does go south, the speculator might just decide to disappear, or at the very least, the farmer still has the headache of chasing the money from the speculator. And this is why exchanges came into being. They standardized the agreements, and this standardized version is known as a futures contract. It's still agreeing a price now for delivery of a product at some point in the future, but it's all standardized by the exchange. The farmer still offsets his risk. He does it now by selling these standardized contracts of corn on the exchange. The liquidity on the exchange comes via the speculators who come to the exchange. So the exchange facilitates the coming together of hedges and speculators. So our farmer doesn't have to seek out his buyer. He also doesn't have to worry about settlement of money because the exchange pays him for the corn that he sells and takes on responsibility of ensuring the speculator pays. When you trade commodities with Trading 212, you are trading what is known as a CFD, a contract for difference. Basically what that amounts to is that the position you trade is always settled up for cash. And we'll look at some specific examples of trades in future videos to make this totally clear how this works. The relevance of the exchange is that trading 212 offsets the exposure of your trades, whether those be in coffee or gold or oil or whatever, by hedging on futures exchanges. Well, I hope you enjoyed this introduction to the commodity markets. If you did, please just take a moment to hit the thumbs up button and give us a like. Or why not share your thoughts with us in the comments section? Which commodity do you trade? Which commodity do you want to trade? Let us know. Send us a message. We do read every single one we receive there. But that's all for now from me, Peter Martin, and Trading 212. Thanks for watching. I'll see you next time. Goodbye.